This is Even, CFA Charterholder and investment professional, and today I'll be comparing FDVV, SCHD, and CGDV, three ETFs with different approaches toward value oriented dividend strategies. Any of these can be used as a part of an income portfolio or to complement more growth oriented strategies based on things like a NASDAQ, the momentum factor, the Russell and 1000 growth, or the many other flavors of chasing what's been hot lately. I'll introduce each of them at a high level, then show how they stack up on a range of metrics from yield to expenses to returns in different market environments so you can decide which one, if any, is right for you. Let's start with an overview of FDVV, the Fidelity High Dividend ETF. This is a passive index fund that tracks the Fidelity High Dividend Index for 15 basis points or 0.15% per year. So, what is the Fidelity High Dividend Index? Well, it's essentially a factor index that tries to capture the yield factor, but a couple wrinkles that I'll cover in a second. A factor is basically a characteristic of a stock, but explains its performance. It's kind of like how tall is a characteristic of a person. Tall people are usually better at basketball than short people. Not always, but more often than not, they are. There are a number of factors, or basically qualities or characteristics, of companies that have led to better risk adjusted returns over long periods of time versus the broad equity market, and high dividend yield is one of them. You can see the other common ones here at the top. Just like how tall people are often better at basketball than short people, but not always, high dividend paying companies often do better than low dividend paying companies in stock market downturns, but not always. Even though they may not participate as much on the upside, in the long run, they've offered an attractive risk adjusted return profile compared to the overall stock market. The added bonus for income investors, of course, is that they also tend to offer a higher yield. So, FDVV tracks the Fidelity High Dividend Index, which invests in large and mid cap companies that are expected to pay and grow their dividends to create a portfolio with a higher yield than the broad market. To decide which companies go in the index, they screen in based on three factors: dividend yield, payout ratio, and dividend growth, with a 70% weight on dividend yield and only 15% on the other two. But even then, they don't just buy the companies that score the highest. They also make a size adjustment so that the overall large mid cap weights are about the same as the overall market. For example, if their initial scoring system would generate a portfolio of a lot of mid caps, they'll de emphasize those and invest extra in large caps to avoid any factor exposure to the size factor. Physically, they don't want it to look too different from the index in ways other than a higher dividend yield. They also allow up to 10% in international stocks, since about 90% of the 3+% dividend paying companies in the world happen to be outside the United States. They emphasize the sectors with the highest yield, and within each sector, they adjust holdings down to avoid too much concentration. Once they put all this together, they have their index. What's interesting about this approach is that the size adjustment really takes over and causes it to own some odd things for a dividend portfolio, like its top holding a nearly 7% position in Nvidia, which pays a 0.03% dividend. I guess it's technically eligible because it pays a dividend, but I wouldn't exactly call Nvidia a high dividend paying company that I would expect to see as the largest holding in a fund called Fidelity High Dividend. SCHD, the Schwab US Dividend Equity ETF, is matched a lot more like what you'd expect from a high dividend ETF. It's based on the Dow Jones US Dividend 100 Index, which has 100 stocks that have paid dividends at least 10 years in a row and have strong enough balance sheets to keep doing it, according to a computer-driven formula of financial metrics chosen by the people at S&P Dow Jones. It also only invests in companies within the highest yielding half of US stocks, so no Nvidia, and it also has limits in place so that it doesn't get too concentrated in any one company or sector, so also no 7% holdings. The fund is mostly made up of high quality, well established, blue chip companies like Chevron, Home Depot, and Verizon. Its focus on high quality companies with higher yields than the market tends to lead to a portfolio with lower volatility than the S&P 500 and a healthy dividend yield, which has typically been in the 2.5 to 4% range over the past 10 years. At about 3.5% now, that's right in that range. And at a cost of only 6 basis points, it's even cheaper than FDVV, which was 15 basis points, aka 0.15% per year, or $1.50 for every $1,000 you have invested. If there's one of these ETFs you haven't heard of, I'm willing to bet it was CGDV, the Catholic Group Dividend Value ETF. Since its launch in 2022, it's beaten the hands off of FDVV in blue and SCHD in red. This is only a short time frame, just under 3 years, but numbers like that should certainly at least warrant consideration if you're in the market for a US dividend ETF. Unlike FDVV and SCHD, CGDV is actively managed, and what gives me confidence despite its short track record is that it's managed by Capital Group, which is sort of the king of dividend investing in the mutual fund world. There are U.S. dividend-oriented funds like American Funds, Washington Mutual Investors Fund, the Investment Company of America, and American Mutual Fund have a long histories, all over 50 years of beating the S&P 500 with lower volatility in similar U.S. growth and income or dividend-oriented tech strategies just like CGDB. Now that they're starting to offer some of their funds in more tax-efficient ETF wrappers and at extremely low costs like CGDV at only 33 basis points, it's time for investors to start paying attention. CGDV attempts to build a portfolio of U.S. stocks that can produce an above-average income for its investors and an opportunity for long-term growth. They call this value refined, and I'm only guessing here, but I think what they mean by that was that they focus on specifically dividend-paying companies, not on deep value companies that might be cheap, but because they're on the brink of bankruptcy. Broad, value-oriented funds would include both of those types of value companies. CGDV almost seems, in a way, like somewhat of a middle ground between FDVV and SCHD. It does own some low dividend paying tech oriented companies like Microsoft and Meta, which SCHD doesn't. But it's not quite as concentrated in its top positions as FDVV. And of course, since it's actively managed, it has no obligation to buy companies just because they're big. Of course, FDVV does. All three of these funds are in the large value Morningstar category, but from the big blue rings, you can get a sense of what types of companies they own the most of. Both FDVV and CGDV have much more diversified portfolios, whereas SCHD owns pretty much exclusively value-oriented companies. From the smaller blue dots, you can see that on average, SCHD's holdings are the most value-oriented and the smallest in terms of market cap. That's the size of the company. Remember, the key difference is that CGDV and FDVV try to provide an overall yield higher than the market, but not every company they hold has to have an above-average yield, whereas they do in SCHD. That leads to three key differences. 1, SCHD will typically have the highest yield. 2, SCHD will typically be the most value-oriented, as we just saw, even though they're all in the value category. And 3, CGDV will have more flexibility to do well in different kinds of market environments. Since it's active, it's the only one that can adapt. These portfolio differences are the main reason why SCHD did the best in 2022, when value is heavily in favor, and CGDV and FDVV did better in 2023 and 4, when growth came back into favor. Interestingly, if we take out CGDV, so we can go back a little further to FDVV's inception, we can see that SCHD has actually done better in the long run, and FDVV has only done better recently in the tech rally, probably in part because they own so much NVIDIA. Does that surprise you? Because FDVV's recent popularity has been driven by looking at recent results like this. It's ahead of SCHD so far in 2024, over the past year, the past 3 years, the past 5 years, by a lot in all time frames. So does that mean it's likely to always do better? That's heard what you might hear from the quick day and novice claims you might find elsewhere on YouTube. No, it doesn't. In fact, the recent period we've been in has been highly abnormal, where just a handful of growth-oriented stocks have driven the majority of the market returns in the US. Since FDVV is the only one of these three that blindly takes concentrated positions in some of the largest companies, it's essentially gotten lucky. That's not to say that it's a bad fund or you shouldn't own it. I just would not assume that the recent past is guaranteed to repeat itself. It's not. So here's how I'd choose between these three funds. If all you care about is cost, SCHD is the winner since it's the cheapest. But if you're watching this video, I'm betting you care about more than just that. If all you care about is the yield, SCHD is the highest. If all you care about is style, SCHD is the most value-oriented, and CGDV is the most flexible since it's the only one that's active. All of these will typically be value-oriented though. For returns, obviously these are not guaranteed, but For the time that they've been around, at least, CGDV has significantly outpaced FDVV, even without a 7% position in NVIDIA. The gap between a CGDV and SCHD has been even wider. I also have confidence in its long run potential given how well the similar Capital Group mutual funds have done over the last 50 years. That said, I think the magnitude of excess return we've seen over these other two, the last 2+ years, is probably not likely to repeat too often. And there almost certainly will be times that it lags these other ETFs, as all active funds do at certain times. As far as downside protection goes, it's really hard to say, but I'm going to give the edge to SCHD because it has the greatest focus on the high dividend payers, and high dividend payers are basically the main component of all three of these that would lead me to believe that they offer better downside protection than the S&P 500 in most downturns. FDVV didn't get any green checks from me in these categories, but I think if you wanted a strategy that offered an enhanced yield but didn't stray too far from the S&P 500 in other ways, I think FDVV would be the choice here. Or if you want an enhanced yield but think the Mag 7 are likely to keep dominating the rest of the market, FDVV would probably be the choice. For the highest yield, lowest cost, or most likely to do best in a downturn or value stock rally, SCHD would be the best choice in my opinion. And if it were me, thinking about which of these to make a component of a retirement income portfolio or a value-oriented complement to my more growth-oriented holdings, CGDV would be my first choice. If you found this video helpful, hit that like button, leave a comment with what you'd like us to cover next, and subscribe so you won't miss it. And if you'd like to connect with our partner Kyle and I directly, you can do so by joining our Discord through the link in the description below. We'll look forward to seeing you in the next video.